Have you ever felt like you're playing a financial game with rules you don't quite understand? Like everyone else seems to have a secret playbook and you're just winging it? That nagging feeling that despite your best efforts, money remains this elusive, confusing puzzle? If you've ever wanted to truly understand its key concepts, to unlock the hidden mechanics behind financial success and failure, then you're exactly where you need to be. Today, we're diving deep into a profound work that promises to shed light on this very struggle, The Psychology of Money by Morgan Housel. Housel, a seasoned financial writer with over a decade of experience, began writing about finance at the dawn of the 2008 financial crisis. What he quickly realized was that while engineers could explain a bridge collapse with physics, finance was different. It wasn't about formulas, it was about people's behaviors. And that, he says, is as fascinating as it is important. This work is a journey into those often overlooked soft skills that dictate our financial lives. And make sure you stay with me until the very end, because I'm going to share the single most powerful quote from this work, a realization that can fundamentally shift your perspective. If you're ready for a breakthrough, make sure you're subscribed. In the next few minutes, we're going to unlock the secrets from this compelling text. You'll learn why doing well with money has less to do with how smart you are and more to do with how you behave, a practical insight that challenges conventional wisdom. We'll also explore the astounding, almost counterintuitive power of compounding and how it silently builds immense wealth over time, offering reusable strategies for your own financial journey. And perhaps most importantly, we'll discover why having enough isn't about being conservative, but about protecting what truly matters in life, providing an applicable framework for sustainable happiness. These aren't just abstract ideas, they're immediate, actionable insights that can transform your everyday financial decisions. Our journey into the psychology of money begins with a stark realization, one that Morgan Housel introduces with a captivating story from his college days working as a valet in Los Angeles. He encountered a wildly successful technology executive, a genius who had patented key Wi-Fi components in his 20s. Yet, this executive's relationship with money was a mix of insecurity and childish stupidity. He'd flash stacks of $100 bills, brag loudly, and once, just for fun, threw several $1,000s in gold coins into the Pacific Ocean, skipping them like rocks. Days later, he shattered a hotel lamp and when confronted with a $500 replacement fee, incredulously threw $5,000 at the manager, demanding he never insult me like that again. Housel later learned this executive went broke. This vivid anecdote sets the stage for the book's core premise. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. Behavior, it turns out, is incredibly hard to teach, even to the smartest among us. To underscore this, Housel then introduces us to Ronald James Reed, an American philanthropist, investor, janitor, and gas station attendant. Reed, a humble man who fixed cars and swept floors, bought a modest house and lived a low-key life. When he died at 92, he made international headlines. He left over $8 million to his stepkids, local hospital, and library. His secret? Reed saved what little he could and invested it in blue-chip stocks. Then he waited, for decades on end, as tiny savings compounded into more than $8 million. Contrast this with Richard Fuscone, a Harvard-educated Merrill Lynch executive who retired in his 40s to become a philanthropist, only to go bankrupt after heavy borrowing for an extravagant home during the 2008 crisis. Reed was patient, Fuscone was greedy. That's all it took to eclipse the massive education and experience between the two. These stories highlight the unique nature of finance, where how you behave is more important than what you know. This is the soft skill Housel aims to illuminate, guiding us to better financial decisions. One of the first puzzles we confront is why people do such crazy things with money, as Housel puts it. He assures us no one is crazy. This notion, explored in the chapter titled No One's Crazy, posits that our unique experiences with money, shaped by our generation, upbringing, income, values, and economic environment, create wildly different mental models of how the world works. What seems irrational to you might be perfectly logical to me. Imagine someone who grew up in poverty. Their view of risk and reward will differ vastly from the child of a wealthy banker. Housel cites John F. Kennedy's detachment from the Great Depression, a time when his wealthy family had bigger houses, more servants, we traveled more. He didn't truly understand it until he read about it at Harvard. This illustrates a crucial point. Your personal experiences with money make up maybe 0.00001% of what's happened in the world, but maybe 80% of how you think the world works. Economist Ulrike Malmendier and Stefan Nagel's research confirms this, showing that our lifetime investment decisions are heavily anchored to the experiences those investors had in their own generation, especially experiences early in their adult life. The Australian who hasn't seen a recession in 30 years thinks differently about the economy than an American who has lived through several. Even something as seemingly simple as buying lottery tickets, which low-income households spend 4 times more on than high-income ones, makes sense when viewed through their lens. It's the only time in our lives we can hold a tangible dream. This profound realization helps us be less judgmental of others and, crucially, understand the roots of our own financial decisions, which are rarely made purely with a spreadsheet, but at the dinner table, scrambled with personal history, ego, pride, and odd incentives. Adding to this complexity is the shocking newness of modern financial concepts like retirement and the 401k, which are barely a few generations old. We're all essentially newbies in this game, still winging it in a system that's constantly evolving. This leads us to the intertwined concepts of luck and risk, which Housel describes as siblings. They are both the reality that every outcome in life is guided by forces other than individual effort. He returns to the story of Bill Gates, highlighting his 1 in a million head start by attending one of the only high schools in the world with a computer. Gates himself admits, if there had been no Lakeside, there would have been no Microsoft. But then we hear about Kent Evans, Gates' equally skilled and ambitious best friend, who died in a mountaineering accident before graduating high school. Kent experienced 1 in a million risk by never getting to finish what he and Gates set out to achieve. The same force, the same magnitude, working in opposite directions. This shows that when judging people's financial success, both your own and others, it's never as good or as bad as it seems. Economist Robert Shiller echoed this, wishing he knew the exact role of luck in successful outcomes. We tend to ignore luck because it's hard to quantify and rude to suggest it. Similarly, failure is often attributed solely to bad decisions, overlooking the dark side of risk. The line between bold and reckless can be thin, as seen in the stories of Cornelius Vanderbilt and John D. Rockefeller, whose law-flaunting actions are often praised as cunning business smarts in hindsight, but could have easily led to ruin. Housel advises, be careful who you praise and admire. Be careful who you look down upon and wish to avoid becoming. Instead, focus less on specific individuals and case studies and more on broad patterns. Extreme outcomes are often the least applicable. Success is a lousy teacher, Bill Gates once said. It seduces us into thinking we can't lose. But acknowledging luck means acknowledging risk, which can turn fortunes just as quickly. Next, we confront the pervasive and dangerous problem of never enough. John Bogle, the Vanguard founder, shared a powerful anecdote about Kurt Vonnegut telling Joseph Heller that a hedge fund manager made more in a day than Heller earned from Catch-22 in its whole history. Heller's response, yes, but I have something he will never have. Enough. This simple word holds profound wisdom. Housel illustrates its importance with the tragic tales of Rajat Gupta, the former McKinsey CEO worth $100 million, who went to prison for insider trading because he wanted to be a billionaire. And Bernie Madoff, a legitimate market maker earning $25 to $50 million annually before his infamous Ponzi scheme. Both had unimaginable wealth, prestige, power, freedom, and they threw it all away because they wanted more. As Warren Buffett wisely put it, to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. The hardest financial skill is getting the goalpost to stop moving. Modern capitalism, Housel notes, is a prow at two things: generating wealth and generating envy. Social comparison is the insidious problem, as the ceiling of social comparison is so high that virtually no one will ever hit it. The only way to win this game is to not fight to begin with, to accept that you might have enough, even if it's less than those around you. Enough isn't about conservatism.
It's about realizing that an insatiable appetite for more will push you to the point of regret. There are many things never worth risking, no matter the potential gain, such as reputation, freedom, family, and happiness. Knowing when you have enough is your best shot at keeping these invaluable things. This leads us to the astounding concept of compounding compounding, beautifully illustrated by the billion-year history of ice ages. Serbian scientist Milutin Milenkovic discovered that slight, gradual shifts in Earth's tilt and orbit lasting tens of thousands of years cause subtle changes in solar radiation. Russian meteorologist Vladimir Kopin then revealed the fascinating nuance. Moderately cool summers, not cold winters, were the icy culprit. When summer never fully melted the previous winter's snow, a small layer of ice remained. This base made it easier for more snow to accumulate, reflecting more sunlight, exacerbating cooling, and leading to a continental ice sheet within a few hundred years. As glaciologist Gwen Schultz noted, it is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts. The lesson for money is profound. You don't need tremendous force to create tremendous results. If something compounds, a small starting base can lead to results so extraordinary they seem to defy logic. Consider Warren Buffett. His $84.5 billion net worth is not just due to being a good investor, but being a good investor since he was literally a child. A staggering $84.2 billion was accumulated after his 50th birthday. If he had started at 30 and retired at 60, his net worth would be 99.9% less. His skill is investing, but his secret is time. Even Jim Simons, who compounded money at 66% annually since 1988, 3 times Buffett's rate, is 75% less rich because he started later. The counterintuitive nature of compounding means we often overlook its power. Linear thinking is so much more intuitive than exponential thinking. Housel highlights the explosive growth of hard drive storage, from 296 megabytes gained between 1950-1990 to 100 million megabytes gained since 1990. Few would have predicted 30 million times larger within my lifetime. Bill Gates even questioned Gmail's gigabyte of storage in 2004, anchored in the old paradigm. The most powerful and important book should be called Shut Up and Wait. It's just one page with a long-term chart of economic growth. Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. For those who value financial wisdom, remember to subscribe to the channel. It's your way of ensuring you don't miss out on more insights like these that can truly transform your understanding of money. This brings us to the crucial distinction between getting wealthy versus staying wealthy. Housel asserts there are a million ways to get wealthy, but there's only one way to stay wealthy, some combination of frugality and paranoia. He revisits the 1929 stock market crash, which made Jesse Livermore, a brilliant trader, one of the richest men in the world by shorting the market. Simultaneously, multimillionaire real estate developer Abraham Jermonsky was ruined, perhaps taking his own life, after betting heavily on surging stocks. But just 4 years later, Livermore, overflowing with confidence, made increasingly large leverage bets, lost everything, and eventually took his own life. Both men were excellent at getting wealthy and equally bad at staying wealthy. Michael Moritz, the billionaire head of Sequoia Capital, attributes his firm's 4 decades of success to being always afraid of going out of business. He says, "There's a lot of truth to that. We assume that tomorrow won't be like yesterday. We can't afford to rest on our laurels." This survival mentality is key because compounding only works if you can give an asset years and years to grow. Warren Buffett's longevity, investing consistently from age 10 to at least 89, is what made compounding work wonders. Rick Guerin, a third member of Buffett and Charlie Munger's investing circle, was just as smart, but was in a hurry. He used margin loans and was forced to sell his Berkshire stock during the 1973 to 1974 downturn, effectively disappearing from the investing elite. As Nassim Taleb put it, having an edge and surviving are 2 different things. The first requires the second. You need to avoid ruin at all costs. This means being financially unbreakable and planning on the plan not going according to plan. It requires room for error, a frugal budget, flexible thinking, a loose timeline, and a barbelled personality. Optimistic about the future, but paranoid about what will prevent you from getting to the future. The U.S. economy's 20-fold increase in living standards over 170 years was punctuated by wars, recessions, and disasters. You need short-term paranoia to keep you alive long enough to exploit long-term optimism. The concept of "tails you win" reveals how a few extraordinary events drive most outcomes. Housel shares the story of Heinz Berggruen, a renowned art dealer who bought vast quantities of art. While perhaps 99% of the works turned out to be of little value, the other 1%, Picasso's, Braque's, Klee's, made him stupendously rich. The great art dealers operated like index funds. Similarly, Walt Disney's first studio went bankrupt, and most of his early cartoons lost money. But Snow White and the Seven Dwarfs changed everything, making $8 million in its first 6 months, an order of magnitude higher than anything before. In business and investing, long tails, the farthest ends of a distribution of outcomes, have tremendous influence, where a small number of events can account for the majority of outcomes. Venture capital is a prime example. Correlation Ventures found that 65% of venture financings lost money, but 0.5%, about 100 companies out of 21,000, earned 50x or more, driving the majority of the industry's returns. Even in the Russell 3000 index of public companies, 40% lost at least 70% of their value and never recovered, yet the overall index returned 73-fold since 1980 because of a mere 7% of companies that outperformed by at least 2 standard deviations. This means it's normal for lots of things to go wrong, break, fail, and fall. As Peter Lynch said, if you're terrific in this business, you're right 6 times out of 10. Jeff Bezos embraces this, stating, "If you think that's a big failure, fire phone, we're working on much bigger failures right now." The key is to do the average thing when all those around him are going crazy. Housel illustrates this with a thought experiment. An investor who consistently saves $1 a month from 1900 to 2019 ends up with almost 3/4 more money than investors who try to time recessions, Jim and Tom. Your success as an investor will be determined by how you respond to punctuated moments of terror, not the years spent on cruise control. Even Warren Buffett admits he made most of his money on only 10 out of 400 to 500 stocks. "It's not whether you're right or wrong that's important," George Soros once said, "but how much money you make when you're right and how much you lose when you're wrong." Perhaps the highest form of wealth is freedom, the ability to wake up every morning and say, "I can do whatever I want today." Housel explains that control over doing what you want, when you want to, with the people you want to, is the broadest lifestyle variable that makes people happy. Money's greatest intrinsic value, he argues, is its ability to give you control over your time. He recounts his brief, miserable investment banking internship, realizing that doing something you love on a schedule you can't control can feel the same as doing something you hate. This feeling is called reactance, the desire to feel in control. Derek Simons, a successful entrepreneur, found true freedom when he had saved just $12,000 at age 22, enough to quit his job and become a full-time musician, covering his $1,000 a month living costs. The later sale of his company for millions didn't make a big difference in my life. That was just more money in the bank. The difference happened when I was 22. Despite the U.S. being the richest nation, Americans aren't happier than in the 1950s, largely because we've traded control over our time for bigger and better stuff. John D. Rockefeller, a recluse whose job was to think and make good decisions, understood this. Today, more of us have thought-based and decision jobs where our tool is your head, which never leaves you, leading to a constant feeling of work. Gerontologist Carl Pillemer, after interviewing 1,000 elderly Americans, found no one, not a single person, said that to be happy you should try to work as hard as you can to make money to buy the things you want. What they valued was quality friendships, purpose, and spending quality, unstructured time with their children. Controlling your time is the highest dividend money pays. Following this, Housel highlights man-in-the-car paradox. As a valet, he dreamed of owning luxury cars, believing they signaled success. Yet he realized when you see someone driving a nice car, you rarely think, wow, the guy driving that car is cool.
Instead, you think, wow, if I had that car, people would think I'm cool. This paradox reveals that people tend to want wealth to signal to others that they should be liked and admired. But in reality, those other people often bypass admiring you because they use your wealth as a benchmark for their own desire to be liked and admired. He told his son, what you want is respect and admiration from other people, and you think having expensive stuff will bring it. It almost never does, especially from the people you want to respect and admire you. True respect and admiration, he suggests, are more likely to gain through kindness and humility than horsepower and chrome. This leads directly into wealth is what you don't see. Housel recounts a fellow valet, Roger, who drove a Porsche, leading to assumptions of wealth. Only later did Housel discover the Porsche was repossessed due to defaulting on the loan. Every assumption you might have had about him was wrong. He states, wealth is what you don't see. It's the nice cars not purchased, the diamonds not bought, the watches not worn, the clothes foregone, and the first-class upgrade declined. Wealth is financial assets that haven't yet been converted into the stuff you see. Many people who say they want to be a millionaire actually mean, I'd like to spend $1 million, which is literally the opposite of being a millionaire. As investor Bill Mann wrote, the only way to be wealthy is to not spend the money that you do have. It's like diet and exercise. Exercise is like being rich. Wealth is turning down that treat meal and actually burning net calories. It's hard to find wealthy role models because their success is hidden. Ronald Reed, the janitor who died with $8 million, was nobody's financial role model while he was living because every penny of his wealth was hidden. It's difficult to learn from what you can't see, which explains why building wealth is so challenging for many. So, how do we build this unseen wealth? Housel urges us to save money. He states, building wealth has little to do with your income or investment returns and lots to do with your savings rate. He draws an analogy to the 1970s oil crisis. We overcame it not just by finding more oil, but by becoming more energy efficient. The world grew its energy wealth not by increasing the energy it had, but by decreasing the energy it needed. Similarly, while investment returns are uncertain, personal savings and frugality
Finance's conservation and efficiency are parts of the money equation that are more in your control and have a 100% chance of being as effective in the future as they are today. Wealth is just the accumulated leftovers after you spend what you take in. More importantly, the value of wealth is relative to what you need. Learning to be happy with less money creates a gap between what you have and what you want, similar to the gap you get from growing your paycheck, but easier and more in your control. Past a certain income, what you need is just what sits below your ego. Housel suggests one of the most powerful ways to increase your savings isn't to raise your income, it's to raise your humility. He emphasizes that you don't need a specific reason to save. Saving is a hedge against life's inevitable ability to surprise the hell out of you at the worst possible moment. It buys options and flexibility, the ability to wait, and the opportunity to pounce. This control over your time is an unseen return on wealth, which is incalculable and becoming more important in a hyper-competitive, globalized world. Flexibility, communication, and empathy are the new competitive advantages.
This brings us to a crucial insight: reasonable, rational. Housel argues you're not a spreadsheet, you're a person, a screwed-up, emotional person. We shouldn't aim to be coldly rational in financial decisions, but aim to just be pretty reasonable. He illustrates this with Julius Wagner-Jaureg, a 19th-century psychiatrist who won the Nobel Prize for curing neurosyphilis by inducing fevers with malaria. Though fevers can aid recovery, they hurt, and people universally suppress them. It may be rational to want a fever if you have an infection, but it's not reasonable. Similarly, in finance, people don't want mathematically optimal strategies, but the strategy that maximizes for how well they sleep at night. Harry Markowitz, a Nobel laureate in economics for his work on risk and return, invested his own money 50-50 in stocks and bonds to minimize my future regret, not to maximize returns. Minimizing future regret is hard to rationalize on paper, but easy to justify in real life. Housel cites a Yale study suggesting young savers use 2-to-1 margin on stocks, arguing it's rational because the math works, but absurdly unreasonable because no one could endure 100% loss and stick with it. It's fine to love your investments, as emotional attachment can provide the endurance necessary to put the quantifiable odds of success in your favor. This also applies to home bias in investing, or even day trading in small amounts. If it helps you stick with a broader, more rational plan, it's reasonable. Jack Bogle, a crusader for low-cost indexing, even invested in his son's active high-fee fund for family reasons. Life isn't always consistent. We then delve into surprise. Stanford professor Scott Sagan's quote sets the tone. Things that have never happened before happen all the time. History, Housel warns, is often used by investors as an unassailable guide to the future, but it's not in any way a map of the future. Investing isn't physics. Investors have feelings, making past behavior an imperfect predictor. This leads to the historians as prophets fallacy, causing us to miss the outlier events that move the needle the most. Housel offers a powerful thought experiment. Imagine the world today without Adolf Hitler, Joseph Stalin, Bill Gates, or the Great Depression. These tail events, though rare, have enormous influence. The 9/11 attacks, for instance, indirectly led to the housing bubble, financial crisis, and the student loan crisis. The correct lesson to learn from surprises is that the world is surprising. We must avoid assuming past worst-case scenarios define future boundaries, a failure of imagination akin to the Fukushima nuclear reactor built only to withstand past historical earthquakes. Furthermore, history is a misleading guide because it doesn't account for structural changes, like the 401k, 42 years old, the rise of venture capital, or the changing composition of the S&P 500. Benjamin Graham, the father of value investing, constantly updated and discarded his own formulas, recognizing that the situation has changed a great deal since then. The further back you look, the more general your takeaways should be. While human greed and fear are stable, specific trends, specific trades, specific sectors are always an example of evolution in progress. To navigate this unpredictable world, Housel champions room for error. He draws lessons from blackjack card counters who, despite having a slight edge, know they're playing a game of odds, not certainties. They bet more when odds are favorable, but never so right that you can bet every chip. They plan on your plan not going according to plan. Kevin Lewis, a successful card counter, stressed the need for enough money to withstand any swings of bad luck. Benjamin Graham's concept of margin of safety aims to render the forecast unnecessary. Room for error, also called redundancy, is the only effective way to safely navigate a world that is governed by odds, not certainties. We often underestimate this need, fueled by the desire for certainty and the fear of missing out. But room for error lets you endure a range of potential outcomes, and endurance lets you stick around long enough to let the odds of benefiting from a low-probability outcome fall in your favor. Bill Gates ensured Microsoft had enough money in the bank to pay a year's worth of payroll, even if we didn't get any payments coming in. Warren Buffett similarly pledges to always run Berkshire with more than ample cash. Housel suggests assuming future investment returns will be 1/3 lower than historical averages as a personal margin of safety. He warns against optimism bias and risk-taking, such as Russian roulette. No risk that can wipe you out is ever worth taking. Leverage, he cautions, pushes routine risks into something capable of producing ruin. He advocates for a barbelled approach. I take risks with one portion and am terrified with the other. This ensures survival. The story of German tanks in Stalingrad, rendered inoperable by field mice, illustrates that you can plan for every risk except the things that are too crazy to cross your mind. Avoiding single points of failure is critical, like having savings not earmarked for a specific goal, as a hedge against life's inevitable ability to surprise the hell out of you. We then tackle a profound psychological reality. You'll change. Housel shares the story of a friend who, against all odds, became a doctor, only to find it an awful career due to stress and hours. People are poor forecasters of their future selves. The end of history illusion describes our tendency to underestimate how much our personalities, desires, and goals will change in the future. Harvard psychologist Daniel Gilbert notes, at every stage of our lives, we make decisions that will profoundly influence the lives of the people we're going to become, and then, when we become those people, we're not always thrilled with the decisions we made. This makes long-term financial planning incredibly challenging. While compounding favors consistency, many of us evolve so much over a lifetime that we don't want to keep doing the same thing for decades on end. Housel advises avoiding the extreme ends of financial planning, as the benefits of extremes wear off, but the downsides, example, unprepared for retirement, a life spent chasing dollars, become enduring regrets. Balance, therefore, becomes a strategy for endurance and avoiding future regret. Crucially, we must accept the reality of changing our minds. Daniel Kahneman's ability to detonate what we had just done and start over, saying, "I have no sunk costs," is a powerful lesson. Sunk costs make our future selves prisoners to our past, different selves. Abandoning old financial goals without mercy can be a good strategy to minimize future regret and get back to compounding sooner.
Next, Housel reminds us that nothing's free. He recounts the downfall of General Electric under Jeff Immelt, whose leadership was blamed for the company's collapse. Immelt's insight: every job looks easy when you're not the one doing it. The challenges faced in the arena are invisible to those in the crowd. Similarly, successful investing looks easy when you're not the one doing it. Hold stocks for the long run is good advice, but the price is volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you're dealing with them in real time. The Dow Jones Industrial Average returned 11% annually from 1950 to 2019, but it traded at least 5% below its previous all-time high on 98% of days. This never-ending taunt from the market is the price of market returns, the fee. It is the cost of admission.
Many try to avoid this price, attempting grand theft auto, seeking returns without volatility through market timing. Yet, studies show tactical mutual funds often underperform, and average equity fund investors lose out by constantly buying and selling. By trying to avoid the price, investors end up paying double. GE under Jack Welch famously massaged earnings to beat Wall Street estimates, giving shareholders consistency and predictability, but the bill came due years later in mammoth losses. The problem is that the price of investing success is not immediately obvious. It feels like a fine for doing something wrong rather than a fee for getting something good. But if we view volatility as a fee, like paying for a Disneyland ticket, things look different. Market returns are never free and never will be. Accepting this fee is the only way to stick around long enough for investing gains to work in your favor. In You and Me, Housel explores why financial bubbles keep happening. It's not just greed, it's because investors often innocently take cues from other investors who are playing a different game than they are. There isn't one rational price for an asset because investors have different goals and time horizons. A Google stock price that's ridiculous to one person can make sense to another. During the dot-com bubble, Yahoo stock in 1999, valued at a zillion times revenue, made sense to short-term day traders who planned to sell before the end of the day. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. The same occurred during the housing bubble, with flippers buying homes not for long-term value but for quick profits. The danger arises when long-term investors playing one game start taking their cues from those short-term traders playing another. This blind collision hurts someone. This also applies to consumer spending. We are subtly influenced by people you admire, but we don't get to see their goals, worries, and aspirations. A young lawyer's expensive purchases for career appearance are part of their game, not necessarily yours. The key takeaway is to identify what game you're playing and not be swayed by others. Housel's own mission statement, "I am a passive investor optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments." This helps him filter out irrelevant market noise. Then we confront the seduction of pessimism. Historian Deirdre McCloskey observed, "For reasons I have never understood, people like to hear that the world is going to hell." Housel clarifies that true optimism is a belief that the odds of a good outcome are in your favor over time, even when there will be setbacks. But pessimism just sounds smarter and more plausible than optimism. He contrasts a dire 2008 Wall Street Journal forecast of the U.S. breaking into 6 pieces with the actual post-World War II boom in Japan, which would have sounded absurdly optimistic at the time. Tell someone they're in danger and you have their undivided attention. John Stuart Mill noted this in the 1840s. Not the man who hopes when others despair, but the man who despairs is admired by a large class of persons as a sage. Why? Firstly, money is ubiquitous, so something bad happening tends to affect everyone and captures everyone's attention. A recession impacts everyone, unlike a hurricane. Secondly, pessimists often extrapolate present trends without accounting for how markets adapt. The 2008 prediction that the world would run out of oil by 2030 failed to account for the surge in fracking technology spurred by high prices. Problems correct and people adapt. Threats incentivize solutions in equal magnitude. Thirdly, progress happens too slowly to notice, but setbacks happen too quickly to ignore. The Wright brothers' first flight went largely unnoticed for years, while a plane crash quickly made headlines. Similarly, a 70% decline in heart disease deaths over 50 years saves 500,000 American lives annually, but gets less attention than a single terrorist attack. The short sting of pessimism prevails, while the powerful pull of optimism goes unnoticed. In investing, you must identify the price of success, volatility, and loss amid the long backdrop of growth, and be willing to pay it. Stephen Hawking, whose expectations were reduced to 0 at 21, found that everything since then has been a bonus. Pessimism, ironically, reduces expectations, making pleasant surprises more likely.
This narrative power continues in When You'll Believe Anything. Housel imagines an alien observing New York City in 2007 and 2009. Outwardly, little changed. Same buildings, factories, technology. Yet, U.S. households were $16 trillion poorer and 10 million more Americans unemployed. The alien is dumbfounded, unable to see the one thing that changed: the stories we told ourselves about the economy. In 2007, we believed in stable housing prices and prudent bankers. In 2009, that narrative shattered, leading to a cascade of defaults, reduced lending, layoffs, and less spending. Stories are, by far, the most powerful force in the economy. At a personal level, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. These appealing fictions thrive when facing limited control and high stakes. Ali Hajaji, whose sick son needed a cure his Yemeni village couldn't afford, said, "When you have no money and your son is sick, you'll believe anything." Similarly, in investing, the possibility of extreme rewards makes people susceptible to financial quackery, even when 85% of active mutual funds underperform. The bigger the gap between what you want to be true and what you need to be true for an acceptable outcome, the more you are protecting yourself from falling victim to an appealing financial fiction. Furthermore, everyone has an incomplete view of the world, but we form a complete narrative to fill in the gaps. Like Housel's 1-year-old daughter, who explains her dad leaving for work as, "Dad isn't playing with me, and I wanted him to play with me, so I'm sad." We all create coherent stories from limited information. This makes us overly confident in our beliefs and vulnerable to misunderstanding others' decisions, leading to bubbles. Carl Richards wisely states, "Risk is what's left over when you think you've thought of everything." We cling to forecasts, not because they're accurate, but because we need to believe we live in a predictable, controllable world. This illusion of control is more persuasive than the reality of uncertainty. All these threads converge in All Together Now, where Housel offers actionable lessons prefaced by a startling story about a 1931 dentist who, without consent, removed 16 teeth and tonsils from a patient, Clarence Hughes, who later died. In that era, doctors made decisions for patients, believing in a universal and right way to cure them. But this ethos shifted. Medicine now treats patients, acknowledging their wildly different views about what's worth it. Housel applies this to financial advice. I can't tell you what to do with your money because I don't know you. There are universal truths in money, but no single right answer, just the answer that works for you. He recommends finding humility in success and forgiveness in failure, less ego, more wealth, managing money to sleep at night, increasing your time horizon, being okay with things going wrong, using money to gain control over your time, being nicer and less flashy, saving for saving's sake, defining and paying the cost of success, worshiping room for error, avoiding extreme financial decisions, defining the game you're playing, and respecting the mess. Finally, in Confessions, Housel shares what works for him, a personal strategy rooted in the ultimate goal of independence. He cites Charlie Munger. "I did not intend to get rich, I just wanted to get independent." Inspired by his parents' frugal mentality, which allowed his ER doctor father to quit after 2 decades, Housel and his wife have maintained a lifestyle established in their 20s, allowing virtually every dollar of raise to accrue to their independence fund. They've got the goalpost of lifestyle desires to stop moving at a young age. This means comfortably living below what you can afford without much desire for more removes a tremendous amount of social pressure. They even own their house without a mortgage, which Housel admits is their worst financial decision on paper, but the best money decision for their peace of mind and sense of independence. They also keep a high percentage of assets in cash, around 20%, which is indefensible on paper, but serves as the oxygen of independence, ensuring they're never forced to sell stocks.
His investing strategy has shifted from stock picking to dollar-cost averaging into low-cost index funds, believing it offers the highest odds of long-term success given their frugal lifestyle. He concludes, "One of my deeply held investing beliefs is that there is little correlation between investment effort and investment results." His strategy relies on a high savings rate, patience, and optimism that the global economy will create value over the next several decades. Ultimately, the goal is independence and sleeping well at night, because no one is crazy. Powerful quotes. The world is full of obvious things which nobody by any chance ever observes. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. Your personal experiences with money make up maybe 0.0000001% of what's happened in the world, but maybe 80% of how you think the world works. Yes, but I have something he will never have: enough. To make money they didn't have and didn't need, they risked what they did have and did need, and that's foolish. His skill is investing, but his secret is time. The ability to do what you want, when you want, with whom you want, for as long as you want, is priceless. It is the highest dividend money pays. Wealth is what you don't see. Do not aim to be coldly rational when making financial decisions. Aim to just be pretty reasonable. Things that have never happened before happen all the time.